Good day everyone, this is Ivan, the moderator for this webinar. I welcome everyone to today's webinar, which is staying updated on fringe benefit taxation. I want to introduce our presenter for today, Dinah GM. Dinah is currently the Director of Payroll Operations at Anne and Robert Lurie Children's Hospital of Chicago. Dinah has been heavily involved in the payroll field for over 17 years. She obtained her FPC Fundamental Payroll Certification through the American Payroll Association. Dinah has her CPP Certified Payroll Professional through the APA. I would now like to hand over the floor to the speaker. Over to you, Dinah.
Thank you and welcome. So first, let's talk about what we are going to review today. So first, we're going to understand the criticality of the golden rule, I consider it, of the IRS and how taxation is determined. So definitely want to review that with you. We'll talk about the fair market value, fringe benefit taxation, and IRS non-cash special accounting rule. Then we'll talk about some excludable fringe benefits. Then we'll talk about some specific employer excludable benefits, and then some executive ones that don't come up as often. So as you can see, lots to review in a short period of time. So let's get started. So why do I start out with what is this golden rule? All right, so let's start talking about once you've determined that something is taxable, what is it? How do you know what to tax, right? All right, so when do you have to record fringe benefits? Well, you have to record fringe benefits based on 3 critical criteria. What is that special accounting rule I was talking about? Right, excludable fringe benefits. So there are some big categories of excludable fringe benefits that you can put some things under that can be really helpful to you. One is no additional cost services. All right, employee discounts. These are really popular in retail. All right, working condition fringes. This is really, again, work-related property or service. Again, it must be related to the business. All right, de minimis fringe benefits. So the IRS's definition is really around the property being so little in value that accounting for it would be unreasonable or administratively impractical. Now, qualified transportation, these are commuting benefits. All right, athletic facilities. Athletic facilities are typically going to be taxable unless you have an athletic facility that meets all 4 of these requirements. All right, qualified retirement. So if you get any retirement planning advice for your employer-sponsored programs, 401k, 403b, 457s, 501c's, SEP, or Simples, that is completely non-taxable. All right, achievement awards. So from an achievement awards perspective, some key things, it is length of service or safety awards. Another key thing here is to remember accident and health benefits. Section 125 plans. So from a Section 125 plan perspective, some key things here is that, again, Section 125 is, again, only medical, dental, vision, those kinds of things. Adoption benefit. So for 2025, you can give up to $17,280 per employee. All right, dependent care assistance. So you can give up to $5,000 per year. Educational assistance. You can give up to $5,250. Moving expense reimbursement. So again, moving expenses are considered all taxable right now because of the Tax Reform Act being in place. All right, lodging on business premise. So if it's furnished on the business premise. Meals typically are de minimis. Tax reform did not change the taxability of eating facility. All right, so executive comp, I'm not going to go through all of the detail in here because this won't impact all of you as you look at these. Like the commuting method, you can't be a 1% shareholder. However, annual valuation method is typically used for a lot of executives because then it's based on the cost of the car. Aircraft usage, I'm not going to go over this one, but the information's in your handout. Reimbursements. Typically, reimbursements are considered taxable income. Stock options, I'm not going to go over these, but they are in here. So you've got your employee stock purchase plan. Currently, the value of property transferred, that's an important element. You do need to qualify, do these things from an equity compensation perspective. The details of those W-2 boxes and everything is in your handout. Bonuses, again, from a taxation perspective, It is supplementally taxed up to 22%. Termination pay, so some key things between severance, golden parachute payments, and those outplacement services. Group term life, this does impact employees with that are not technically executives. Qualified travel business expenses. Frequent flyer miles are typically not taxable as long as it is a benefit given by the airline. At home office expenses, this one comes up a lot, so I like to mention it. And then again, here are some key things from an includable perspective. All right, so we've covered a lot of information in a short period of time. Again, thank you so much for attending today's session. I hope you got a lot of valuable information out of today's session, and I want to wish you all a very pleasant day ahead.
Thank you, Dinah. That concludes the session for today. And thank you everyone for participating. You may all disconnect now and you may all have a great day.